Hello, everybody. So first of all, don't be alarmed, post meltdown shopping list, post crash shopping list. It's true that the crash yesterday, I mean, we've had dozens of these, and if one can't handle that, one, I guess, shouldn't really be in the market. It's the nature of the market. But, Tesla down almost 9%, right? From 235 almost to 210. It kind of makes you think the market makes very little sense. It's a buying opportunity. I buy a little bit of stocks every day, and I was able to actually buy a little more this past Friday, end of day. I bought at the end of day. I bought it around 2 p.m. My time. I bought 3 stocks. I bought Tesla, more, right? And trust me, I have enough Tesla. I bought HIMS, more, and trust me, I have enough IMS. And I started a position in Supermicro. Even though I have not covered it for the channel yet, but my due diligence is going well on this stock, and I'm now tracking it. It's now a very tiny position, but I started a position kind of secretly, hope it goes down a little more. It's almost back at the level where it was before the run. The stock that I did not buy was Nvidia. I haven't bought it yet. I would love to get back into Nvidia at 100, and it really sucks to have missed out on the gains. But Blackwell is not canceled. Early 2025 is still gonna be, I think, pretty big for Nvidia, and so I would be very interested in getting back in. So really briefly, I recalculated the valuation as of Friday end of day for my favorite stocks and or the stocks that are on my shopping list. So let me just go ahead and tell you. So HIMS, I covered HIMS yesterday. HIMS, growing sales very quickly, predicted to grow at 53%, EBITDA margin 11%, gross margin 82%. The cheapest stock in today's spreadsheet, the cheapest stock of any spreadsheet I ever create whenever I put HIMS in there. How much am I paying for that growth for HIMS? I'm paying a 0.059. So that's as cheap as it's ever been in the channel. The rule of 40 is a 64, so this is a high performance stock. The stock that I added was Supermicro SMCI. They go hand in hand with Nvidia, right? As Nvidia sells more products, Supermicro sets it up, and Supermicro is the leading rack provider for Nvidia systems. Now, if you look at Supermicro, right, it's predicted to grow at 64%, so not quite as much as Nvidia, because of course there's other rack providers, but it's predicted to grow quite enormously. The gross margin for Supermicro is not that good, but you can see that out of the gross margin, most of it turns into EBITDA margin, right? Most of it turns into economic profit. So this is a company that is well optimized for profit. EV over EBITDA, for example, is 18 on Supermicro, which is cheaper than HIMS. And you know that I treat HIMS as like the cheapest stock as I have seen. Rule of 40 is a 73. You're getting into insane numbers. You're getting into something like a Transmedics, into something like a Celsius. Not quite anything like a Nvidia, but no stock is like Nvidia as far as the rule of 40 goes. Let me move on to the Nvidia. So, Nvidia, it was just 3 or 4 weeks ago, it was at 3 trillion in valuation. Now it's back at 2.6. Who knows if it keeps dropping, maybe it'll get at 2.5. But this company is predicted to grow 86%. So almost a doubling again of the sales. The gross margin is 76%. The EBITDA margin is 64%. Think about that. That's a company that's more profitable than a Visa, to tell you. It's pretty crazy. So of course, when a company is this profitable, it deserves to trade at such a premium. And when I adjust for everything I like, I use enterprise value over gross profit, over revenue growth, over a 1 year period, right? Next year, the revenue growth over next year, how much am I paying for next year's growth? I'm paying a 0.41 per 1%. And that is what you get when you have an expensive stock that is growing also tremendously. And in the case of Nvidia, growing faster than all of the other companies that I present in today's video. That's actually in the second here, in the first half though of all of the stocks I cover. Nvidia is getting cheaper and cheaper and cheaper, because they are growing faster and faster and faster. I am interested in getting back into that stock. It was a mistake of mine. I admitted that mistake. It was a mistake of mine to sell it too early. I found that stock overvalued for a long time. AI is not a fad. Talking about Airbnb. So Airbnb, I can't remember if I had made a video about that. It was probably during my break, but I sold out of Airbnb and I avoided quite a bit of a drop because I had sold out of it. And now this is a stock that I would be looking to get back in. I think the stock is okay valued, but I also like Airbnb because it has a real network type of moat. I will cover Airbnb more on the channel, but the matter is it's on my watch list right now. Same for Coinbase. So I still own Coinbase. I haven't sold out of Coinbase. It's still a position. I haven't sold a single share. I am looking to add more to Coinbase because we are in a crypto spring, about to enter a crypto summer. What happens during those? Well, trading, on-ramping goes on, more and more of it. And of course, how does a company like Coinbase make money? Through the on-ramp, through trading, right? ETFs, when they buy Bitcoin, who do they buy it from? Coinbase, right? A lot of staking goes through Coinbase. A lot of projects are supported through Coinbase. Coinbase, USDC, obviously, right? USDC, half of USDC, the company, is owned by Coinbase, and so they earn the interest on those bonds. Coinbase has an outstanding gross margin at 86%. Notice how it's the highest gross margin of all the stocks that I covered today. EBITDA margin is very high at a 30%, and the company, again, it is a little expensive if you compare to HIMSS or SMCI, but if you compare to all of the stocks in my channel, it is not that expensive. Now, moving on to two companies which I love, but that don't really work well in my spreadsheet because my spreadsheet punishes both Tesla and Enphase heavily because Tesla and Enphase are expensive on the face value, right? It's a forward gross profit. EV over forward gross profit is 37 for Enphase, 25 for Enphase, 37 for Tesla. EV over EBITDA, you're at a 57 and an 87. So this is pretty high. And Tesla's growth, 12.5%, in the auto sector when everybody's dropping by 20%. That's really high relatively. So from a strategic standpoint, I'm loving the strategy of a company. But from a pure number standpoint, over the short term, it's not very good. Enphase, of course, over the short term is not good because it's predicted to decline its sales. But what do we know about Tesla and Enphase, right? The products, both of them, are heavily dependent on interest rates, and the interest rates are going to drop maybe 25 basis points, maybe 50 basis points in September. This will be the first of a line of many interest rate drops, which in my view are going to make these stocks hot again. These stocks are also at the heart of their respective disruptions. Tesla is the uncontested disruptor in the vehicle, in the automobile sector. The disruption is moving from gas car to electric cars, and they are absolutely winning that disruption. Follow what happened to Volkswagen 4 days ago, announcing they are going to close plants in Germany for the first time in something like 89 years, I believe. So Tesla, in my view, is winning, and there's so many good things to say about Tesla. I don't have enough time, and tons of channels out there. Enphase, I believe, is going to go through a same wave of new cells of solar as electricity becomes more expensive, as AI competes for electricity from the grid. Enphase is going to become more and more compelling as electric vehicles gain traction. Enphase becomes more compelling because all of a sudden you can produce your own energy to charge your car. Enphase, in my view, is a very compelling play. And they are in the right market in the solar business, which is the microinverter market. And there's many reasons for that. One of them is a safety reason as far as fire problems by running DC through the roof. Another reason is, of course, the form factor. It's a very small semiconductor-based form factor, which makes it very easy to manufacture. Enphase has a catalyst coming up. I need to address that in the next video. It's the GaN microinverters. The gallium nitride is coming up, and that's going to greatly increase the efficiency of microinverters for Enphase. Don't forget that the IRA benefit for Enphase is based on that efficiency. There's a lot of bullish things that I love about Enphase. The valuation compared to the best-in-class nature of this stock, in my view, is very good, and I'm happy to buy it. And the last stock that I am buying right now, I haven't had it on Friday, but I'm going to be looking on adding to this one on Monday, and it's Microstrategy. Microstrategy is now in the 110s. So Microstrategy, in my view, is very inexpensive right now. And we know that Michael Saylor issued $2 billion. I don't know when he's going to make that purchase. Maybe he's waiting for a drop in Bitcoin. But that stock, in my view, the playbook of shorting the US dollar, you short the USD by buying BTC with borrowed USD. I find that playbook to be brilliant from a bit the denominator standpoint. Of course, you'll forgive me if you're new to the channel. Sometimes I cover controversial stocks. Tesla, Enphase, MicroStrategy, you got the most debated stocks in the market right now. And I own all three of these, and I love them very much. So this was it for the watch list. This is my current watch list, and you got an updated spreadsheet if you want to take a look at it and make your own judgment. As always, this is not investment advice, no financial advice, just entertainment. I hope you were entertained. Please like, please subscribe. Thank you so much for watching, and have a wonderful day.